Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, more and more people are being approached with the idea of a private placement. What in our environment has changed that makes these investments more widespread today?
Well, the first factor, Steve, is over the last 15 to 20 years, we've seen a decline in the number of publicly traded companies. So less companies being reviewed by more or the same amount of analysts equal less opportunity in the publicly traded market. Next, we're in a low interest rate environment, and it looks like we're going to be in a low interest rate environment for the foreseeable future. So lower interest rates mean lower expected return on fixed income or bonds. So that's going to push people out on the risk spectrum in search of return, and sometimes that will lead to alternatives or private investments.
There are certain requirements that need to be met for people to invest in these investments. They have to meet a certain net worth and or a certain income stream on an annual basis. Investors need to know also that these investments are extremely illiquid at times. In a normal environment, someone's going to receive either a quarterly income stream, semi-annual income stream, or an annual income stream. You and I both know, though, that the environment is always changing and those rules can change. So that means the income will either change or potentially stop completely.
Yeah, 2020 is probably a great example of the environment changing and a lot of these private investments being affected by that, because it's easy when these products are being sold or discussed to talk about normal environments, but you should consider what's going to happen during extreme environments where liquidity becomes king. Because again, remember, these investments will have a lockup. 7 to 10 years is a normal time frame, and make sure you can afford the liquidity, one, but then make sure maybe more important, make sure you're being compensated for that illiquidity.
Yeah, because there are high costs inside of these investments, whether it's operating costs or the advisors are getting paid up front or they're getting paid throughout the year. All of these fees add up, and it does affect the return longer term.
Right, higher fees compound over time, driving down return, normally. Additionally, more complex investments generally come with a more complex tax situation, and that documentation is generally less timely, which can extend tax returns, right?
Yeah, all the way out to October of that tax filing year.
And that could frustrate clients.
Absolutely. We're not saying, though, Travis, that these investments are either favorable or unfavorable, are we?
No, we're not. There's going to be opportunities, or there are opportunities in the private markets for people to take advantage of. So we're not saying all of them are favorable or all of them are negative. We're just saying set yourself up for success. Understand what you're investing in. Understand the liquidity, understand the time frame, understand the cost, and then understand the tax implications of that. Because proper expectations now will lead to fewer surprises later.
That's absolutely right, Travis. This has been great. I look forward to it next week.
I look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.